What we did last week was to talk about section 6 on implementing the NPV rule. The basic idea is we start with some accounting type of data, and then we figure out the cash flows and discount them back at the opportunity cost of capital. Now the rules that we're going to use are 4 essentially. Rule 1 was that we work with after-tax cash flows. Remember, it's the corporate tax. We'll talk about personal tax later in the course, but we'll work with after corporate tax because you have to pay the money to the government and the owners don't get it. If we have revenues, what are we going to multiply them by to take account of the taxes? 1 minus TC, yeah. And similarly for costs, because costs are tax deductible, you get lower after-tax costs in effect. And so what we're going to do is multiply by 1 minus TC. So that's for cash flows where you actually have to pay something to somebody, or you have a payment to you. We also have these accounting charges. Classic examples, depreciation. You don't actually have to pay that to anybody. So what do we multiply by in that case? Just the tax rate, because the only effect is a tax effect. You have a reduction in your taxable income because you get to deduct depreciation of 1,000, for example, then that's going to save you some taxes. For 1,000 deduction, it's going to save you 350 in taxes with a 35% tax rate. So to calculate the tax shield, we're going to multiply by TC. So that's the first thing to be very clear about. When is it that you multiply by 1 minus TC, and when do you multiply by TC? 1 minus TC when it's a cash flow, so it's an actual payment. TC when it's an accounting charge, so there's just an effect on the taxable income. Rule 2 is to do with timing of cash flows. Remember, accounting revenues and costs don't actually correspond to cash flows. If you book a revenue, for example, doesn't mean you got the money necessarily, and the money you didn't get, we record in the accounts as an accounts receivable. In other words, it's a current asset. Similarly with costs, you may not actually have to pay it yet. We deal with that through accounts payable. We've got to make an adjustment to the accounting data to reflect this timing issues. Now the way that we do that is how? What's the thing that we use to reflect these timing differences? Well, accounts receivable or what? They're an example of a... So that's what we're going to end up. We're going to look at the change in the working capital, because accounts receivable are a current asset, accounts payable are a current liability. The difference between the two is reflected in working capital. So we're going to adjust for the timing with working capital needs. And we'll see how that works. It doesn't just adjust for the timing, it also adjusts for things like inventories, because inventories are included in current assets, so they're included in working capital. Rule 3, we need to work with marginal cash flows. What do we mean exactly by that? Well, suppose we're thinking about doing a project. We look first of all at the cash flows each year generated by the firm without the project, and we compare those with the cash flows generated by the firm with the project. The difference between the two, the with project minus without the project, are the marginal cash flows, and that's what we're interested in. There are a number of things to worry about with regard to identifying these marginal cash flows. We introduce a new product that may affect existing sales. What's that called? That's called cannibalization. And it's an example of an incidental effect. So you need to go through all the operation of the firm and just check, is this new project that you're thinking about doing going to affect other parts of the firm? If you do a test marketing campaign and then make a decision based on the information that you acquire on whether to implement the project or not, what do you do about the costs of the marketing campaign? There are sunk costs, so you ignore them. So you ignore sunk costs. We take them into account before we spend them, so right at the beginning when you're thinking, should we do the project or not, let's start with a test marketing campaign. Then you'd include them, but once you've done them, you don't. If you own a machine, which you're going to use for the project, you don't actually have to pay anybody for it. Does that mean there's zero cost? No. What could you do if you didn't do the project? You could sell the machine, do something with it to get money. That's the opportunity cost. So include opportunity costs. It's not always easy to get market data to find out what they are, but do your best you can. And then finally, be careful with overhead charges. So accountants typically cover fixed costs with overhead charges. As finance people, we're interested in, was there a marginal cash flow or not? So be careful with overhead. Rule 4 was to do with inflation. What are the two ways of thinking about things if we're working in an inflationary environment? First one is nominal, and nominal is actual dollars, actual interest rates. And what's the second one? Real. Real is what would have happened in the absence of inflation. So you're taking out the effects of inflation by dividing by 1 plus the inflation rate. You can work in either nominal or real terms, but you mustn't mix them. In other words, you must be consistent and discount nominal cash flows, nominal discount rates, or work in real terms and discount real cash flows at real discount rates. Are there any questions on any of that?